Hi class, in this video we're going to introduce Chapter 8, Class 3, and we will focus on Corporate Valuation Model, which is also called Free Cash Flow Method. Okay, this is a second model to evaluate stock price after we talk about dividend discount model, the first model. Okay, in this model, instead of discounting all the dividends of the firm to get the firm value, we're going to discount free cash flows of the firm. That's why we call it free cash flow method. Okay, and we're going to talk about free cash flow in this class as well. Okay, and for dividend discount model and corporate valuation model, these two models are for evaluating the stock price of common stocks. We're gonna, in the end of this lecture, we're gonna talk about how to evaluate preferred stock, okay, which is a little bit different from common stock, which is, and its characteristic is in between bond and common stock. Okay, before we talk more about these new models, let's do a quick review on what we have learned in the first two classes in Chapter 9. Okay, in Chapter 9, Class 1, we have constant growth model of the dividend discount model. If we have a constant growth rate of G in all the time for the firm, then we can use D1 over R minus G to get the stock price. Okay, and for PT, it is DT plus 1 over RS minus G. And for this discount rate RS, it is also RI in the CAPM model. So it's risk-free rate plus beta multiplied by RM minus RRF. And in this constant growth model setting, dividend yield would become D1 over P0, which is RS minus G. Capital gains yield is G, and it is the same as dividend growth rate, also the same as price growth rate. The sum of these two, dividend yield plus capital gains yield, G, becomes R. So R equals G plus dividend yield. In the second stage model, we have, or non-constant growth model, we have G1, the growth rate in the first period. We also have G2, the constant growth rate in the second stage. We use 3 steps to look for P0. Step 1, we calculate from D1 to Dn plus 1. Step 2, we calculate horizon value Pn equals Dn plus 1 over Rs minus G2. Step 3, we discount all the dividends in the first stage, D1 to Dn. We also discount the horizon value Pn. Okay, so this is a review of Class 1 and 2. And in Class 3, we're going to talk about how to discount all the free cash flows of the firm by using WACC. So we have the firm value or market value of the firm at time 0, V company 0. And if we assume that all the free cash flows are growing at a constant rate G, we can have the constant growth model of the free cash flow model. So we have free cash flow 1 over WACC minus G equals V company 0. Free cash flow 1 equals free cash flow 0 multiplied by 1 plus G. After we get the firm value, we can use the firm value minus the debt and preferred stock market value. So we have market value of equity left. And we can use market value of equity divided by number of common equity shares. So we have stock price, okay, or equity value per share. P0. In order to have free cash flow, we need to use EBIT multiplied by 1 minus tax rate plus depreciation and amortization minus capital expenditures plus delta net operating working capital. For value of the preferred stock, we need to use VP equals dividend over RP. Okay, value of the preferred stock equals dividend over return of preferred stock. So preferred stock is like perpetuity. It's much easier to calculate its value compared to calculate the value of the common stock. In the corporate valuation model, we're actually calculating firm value first, and then get equity value, and finally get stock price. Okay, so we're working on P0 indirectly here. Since we're gonna discount all the free cash flows to get the firm value in the corporate valuation model, let's first look at the definition of free cash flow. It is a measure of company's financial performance calculated as operating cash flow minus capital expenditures. Free cash flow represents the cash that a company is able to generate after spending the money required to maintain or expand its asset base. Free cash flow becomes EBIT multiplied by 1 minus T plus depreciation and amortization minus capital expenditures plus delta net operating working capital. Free cash flow is the firm's after-tax operating income less the net capital investment. Let's take Home Depot as an example. The first term here represents the amount of cash that the firm is generating from its existing store. The second term represents the amount of cash the company plans to expend this period to construct new stores. Cash is spent to purchase the land and construct the buildings are the capital expenditures, and they lead to an increase in the firm's fixed assets as shown on the balance sheet. Home Depot also needs to increase its working capital, especially inventory. Altogether, HD generates positive free cash flow for its investors if and only if the money from its existing stores exceeds the money required to build and equip its new stores. Okay, so we only have positive free cash flow if the first term, after-tax operating income from the existing store minus the expenditure on the new stores is positive. And for the dividend discount model we learned in the last two classes, it's not working for some firms because some firms do not pay dividends, and also dividends are dependent on earnings. A reliable dividend forecast must be based on an underlying forecast of the firm's future sales, costs, and capital requirements. The recognition has led to an alternative enterprise-based stock valuation approach, the corporate valuation model. Okay, because for some firms, we cannot use dividend discount model. Okay, depending on their payout policy, they could not pay out dividend, or they pay out dividends. It's just they do not do well in some years, so they don't have dividend to pay out. So we have this alternative approach, corporate valuation model. We also call it free cash flow model because we discount the firm's free cash flows to get its present value, and this equals the value of the entire firm. Okay, step one, we get the market value of the firm first. Okay, in the dividend discount model, we get the intrinsic value of the stock price directly by discounting all the dividends. Here, we have the firm value first. Then we remove the debt and preferred stock part, so we have the equity value. Then we divide by number of shares, so we have value per share, which is the stock price. So here we're solving for stock price indirectly. Formula, the value of the firm equals the present value of all the expected future free cash flows. So we have V company 0, the value of the company today equals all the free cash flows from free cash flow 1 to 2 to infinity, discount by 1 plus WACC. Okay, here when we were discounting dividends, we were using stock return, cost of equity as the discount rate. Here we're using WACC because we're discounting free cash flow. Okay, WACC is weighted average cost of all the firm's capital, including debt, preferred stock, and common equity. And we're going to discuss more on it in chapter 10. Okay, so we do not only look at, for dividend, we only discount by using cost of equity. Here we have to use a comprehensive measure because we're discounting free cash flow. Okay, so we are using the cost of the firm, cost of capital. Okay, it's the weighted average of cost of debts, cost of preferred stock, and cost of common equity. For this corporate valuation model, we also have a constant growth model version if free cash flows are growing at a constant rate G forever. Then this value of the firm at time 0 becomes free cash flow 1 over WACC minus G, which is also free cash flow 0 multiplied by 1 plus G over WACC minus G. Okay, very similar to the constant model for the dividend discount model. For non-constant growth model of this corporate valuation model, we need to discount free cash flow in the first stage one by one. And for the second stage, we need to solve for the horizon value, which is VN, company value at time N. We can also use TVN, terminal value at time N, equals to free cash flow N plus 1 over WACC minus G2. Again, this is very similar to how we calculate horizon value in the dividend discount model. Okay, it's just we're switching dividends to free cash flows here. We're switching price to value of the firm here. We're switching R to WACC here. Term value N represents value of firm at the point that growth becomes constant. It's called horizon value, continuing value. Okay, so if we have horizon value, we have free cash flows from 1 to N. We can discount free cash flow 1 to N and also discount TVN. So we have value of the firm at time 0. Okay, so no matter it's constant or non-constant growth model, we can get the value of the firm. After that, we can do our step 2 using market value of the firm minus market value of debts minus market value of preferred stock. So we have market value of equity left. And then we divide market value of common stock by the number of shares outstanding to get intrinsic stock price, intrinsic value per share. So we use this market value of equity divided by number of common equity shares. So we have P0, market stock price. Okay, let's look at it. I guess for this notes, we repeat the first and second page twice. Okay, we have to go to page 6. Okay, excuse me for the error that page 1, 2 is the page 2, 3 are the same as page 4, 5. Okay, we need to jump to page 6 to the new contents and look at an example. Using corporate valuation model to find the firm's intrinsic value, given long run growth rate of free cash flow is 6%, G2 is 6%, and WACC is 10%. And we know free cash flow 1, 2, 3. Okay, so it is given on the timeline here that free cash flow 1 is -5, free cash flow 2 is 10, free cash flow 3 is 20, WACC is 10%, and G2 is 6%. So our step 1 is to find the market value of the firm. In order to do that, we need to get free cash flow 4 in year 4 first and calculate terminal value at year 3, TV3. So we already know free cash flow 3 as 20. We can use that number multiplied by 1 plus G2, 6%. So we have free cash flow 4 as 21.2. Then we can use this number divided by WACC minus G2. So we have TV3 as 530. Then we can discount from cash flow 1 to cash flow 3 and TV3 to get the present value, which is the market value of the firm. So we input in the cash flow function that cash flow 0 is 0, cash flow 1 is free cash flow 1 as -5, cash flow 2 is free cash flow 2 as 10, cash flow 3 is free cash flow 3 plus TV3. So it's 20 plus 530. It should be 550 entered as cash flow 3. Press NPV function, input WACC as I, 10, enter, down button, compute. We can get net present value of all the free cash flows as 416.942. Alternatively, you can also discount manually one by one. For free cash flow 1, it's -5 divided by 1 plus R, 10%. So we have -4.545. For cash flow 2, we have 10 divided by 1 plus 10% square, 1 plus WACC square. So we have 8.264. For free cash flow 3, we can use 20 divided by 1 plus 10% cube. So we have 15.026. For TV3, we can use 530 divided by 1 plus 10% cube. So we have 398.197. Add these up, we can have 416.942 as the firm value at time 0. Step 2, we can use the firm value that we just solved, 416.94, minus the given, this is given by the question that the market value of debt and preferred stock is 40 million. Okay, so we have 376.94 million as market value of equity. It's also given that we have 10 million shares of stock, so we can use the market value of equity divided by number of shares. 376 divided by 10. So the intrinsic value per share, the stock price, is 37.69. Okay, so here is the 3-step for looking for the firm value, looking for the market value of equity, and finally the stock price. And in the first step, it's a 2-stage model here to solving for the market value of the firm. Okay, so that's free cash flow model or corporate valuation model to get stock price. And for free cash flow model and corporate dividend discount model, those are for common stocks. What if we have preferred stock? It's a hybrid security. It's very special because it's between bond and common stock. Similar to bonds, preferred stock has a par value. Its fixed dividend must be paid before dividends can be paid on the common stocks. So preferred stock is a perpetuity. However, companies can omit preferred stock payments without fear of pushing the firm into bankruptcy. Skipping the payment will not lead to bankruptcy. So it has the bond feature that we get paid at a fixed dividend, at a fixed level. Okay, just like you receive when you receive coupons from the bond, you have par value and fixed dividends for preferred stock. Okay, but it's also like stock, so you get the dividends on and on. There's no maturity date. It could be a perpetuity. Preferred stock is also similar to common stock in the way that if the firm fails to pay the dividend, the firm does not go bankruptcy. Okay, so this is the order. The firm usually pays debt first, and then it pays preferred stock next at fixed dividends. Finally, the firm would pay common stock dividends. So debt is safest, preferred stock is in between, common stock is riskiest or most risky. Okay, for example, if we have a preferred stock with an annual dividend of $5 selling for $50, what is the preferred stock's expected return? Here we know we have $5 dividend paid out every year. The stock price is 50. We want to look for the return. Okay, for perpetuity, we know present value of a perpetuity is payment over R. For the preferred stock here, the value of the preferred stock equals dividend divided by return of the preferred stock. Okay, the payment of the dividend here becomes, the payment of the perpetuity here becomes the dividend, $5. Okay, so the stock price 50 equals $5 dividend over R, the stock return. So stock return becomes 5 over 50, which is 10%. Okay, preferred stock formula is very similar to perpetuity formula. Okay, that's preferred stock. Now we can look at another example where we have corporate valuation model for getting the stock price. Again, if you didn't understand our first model in these notes, you can go back and try to digest it. And for this second example here, I would recommend you to pause the video now and read this example question here on your own and try to work on this question by using 3 steps of the corporate valuation model to find the stock price per share. Okay, and you can resume the video once you finish working on this question, and we can discuss the solution together. Okay, so if you have finished working on this second example question here, let's look at the solution, okay? If you need more time, you can again pause the video now and work on this question and resume it after you finish. This firm invests a large sum of money in R&D. As a result, it retains and reinvests all of its earnings. In other words, this firm does not pay any dividends, and it has no plans to pay dividends in the near future. A major pension fund is interested in purchasing Barrett's stock. Barrett's free cash flow for this year is $15 million. Free cash flow 0 is $15 million. And is projected to grow at a constant 7%. Okay, we know G is 7%. Barrett's weighted average cost of capital, WACC, is 12%. Market value of its debt and preferred stock totals $60 million. And it has 10 million shares of common stock outstanding. What is an estimate of Barrett's price per share? Okay, so we're looking for price per share, the stock price, but we don't have dividends here, so we cannot use dividend discount model. However, we know free cash flow here, so we can use free cash flow model. And there's only one stage here, so we can use constant growth model for the whole time period. Okay, we only have one growth rate, 7% here. Step 1, we calculate the market value of the firm. Value of the firm equals free cash flow 0 multiplied by 1 plus G over WACC minus G. Okay, it should be 321. Okay, compared to our first case where we have 2-stage model for the free cash flow model, here we only have 1 stage, so we can get the company value easily. Step 2, we can get the market value of equity by using the value of the total firm, 321, minus the market value of the debt and preferred stock. It's given in the question as 60. So we have 261 as value of equity. Step 3, we calculate the intrinsic value of the stock. So the stock price per share is this value of equity, 261, divided by number of shares, 10 million. So we have 26.1 as the stock price for this firm. Okay, here is another practice of free cash flow model. Again, you can pause the video now to read the question and work on this question without looking at the solutions. And we will discuss the solutions if you finish doing this question yourself. All right, class. If you finished working on this question, let's look at the solution here. If you need more time, you can continue pausing the video. This company forecasts that it will have the free cash flow in millions shown below. Okay, as shown on this timeline here, we have year 0, 1, 2, 3, 4, and the free cash flow for 1, 2, 3 are here. Free cash flow 1 as negative 20 million, free cash flow 2 as 48, free cash flow 3 as 54. If the weighted average cost of capital is 14%, and the free cash flows are expected to continue growing at the same rate after year 3 as from year 2 to year 3, the number of shares is 100 million and the total amount of debt and preferred stock is 789.47 million. What is this firm's stock price? Okay, again, for the free cash flow model, we have to do 3 steps. Step 1, we want to solve for the market value of the firm by using 2-stage model here because we have one growth rate before the third year, before the second year actually. Okay, this question is saying that free cash flows are expected to grow at the same rate after year 3 as from year 2 to year 3. So we know after the second year, free cash flows grow at the same rate. From year 2 to year 3, we have a growth rate, and it's the same as the growth rate from year 3 to year 4, or any year afterwards. So here, a very tricky part is that you have to tell your horizon date is 2. Okay, from year 1 to year 2, free cash flows are given, and there's a growth rate you can calculate here. It should be different from the growth rate of the. It should be different from the growth rate from year 2 to year 3. Okay, but after year 3, it's all gonna be the same G2. All right, so let's first find the growth rate from year 2 to year 3, our G2. We can use free cash flow 3, 54, divided by free cash flow 2, 48, minus 1. So we have 12.5% as the growth rate from year 2 to year 3. And it's gonna be the same next year and all the years after. So G2 is 12.5%. We can also find horizon value at year 2. So TV2, or HV2, the firm value at year 2, becomes free cash flow 3 over WACC minus G. So it's 54 over 14% given WACC minus G2. 12.5% we just calculated. So we have horizon 2 as 3,600. The present value of the free cash flows in the first stage and the horizon value would be the total corporate value. And it's free cash flow 1 over 1 plus WACC, 1 plus 14%, plus free cash flow 2, 48, plus horizon value 2, 3600, divided by 1 plus 14% square. So we have 2789.47 as the corporate value. You can also use the cash flow function and input free cash flow 1 as cash flow 1, free cash flow 2 plus horizon value 2 as cash flow 2, and input WACC as I. Compute for NPV, you should have 2789. After getting the market value of the firm, you can use this number minus market value of debt and preferred stock. So you have market value of common equity. And you can use this market value of common equity divided by number of shares provided by the question. You would have the stock price as $20. Okay, and there's a typo here. We should not have. I hope this works. Okay, delete. I actually want to delete this measure. Okay, so it's actually just $20 because we're using 2,000 million divided by 100 million. So it's only $20 here. Okay. Okay, I just paused recording the video and I made a little bit change on the PDF slides here. Okay, so now it's clear that stock price should just be $20. Okay, there's no million sign here. And I'll update this new PDF document to our Canvas